Good morning. It's Jeffrey Christian of CPM Group. It's 11:10 in the morning on Friday, the 14th of February. Happy St. Valentine's Day. One of the notable characters who grew up in the same neighborhood that I grew up in outside of St. Louis was notable because he was convicted as being one of the gunmen on the St. Valentine's Day massacre, for what it's worth. I want to talk about silver and where the price may go over the next 2 weeks and why it may. I'm calling this silver déjà vu because we've all seen this play before. Silver prices rose sharply this morning. They got as high as $34.24. They're about $34.06, 7 cents right now. And CPM Group's view, our most recent short-term price projection, was that the price could spike as high as $35 in February and then come off, if not in March, later than that. The increase in the Comex price of silver today largely reflected the Comex March silver futures contract being rolled into May. And that's what I want to speak about. Promoters and others think it reflects a breakdown in the silver market, a collapse of the paper silver conspiracy that suppressed silver prices for the last 50 years and other nonsense. It's not anything like that. We keep hearing people talk about how London's going to run out of gold and silver. It's not going to run out of gold and silver. There's an international arbitrage which has caused a lot of gold and silver to be shipped from London to New York because the price is higher in New York than it is in London right now, and because the demand from both investors and fabricators for both gold and silver are higher. That doesn't reflect a breakdown in the international precious metals markets. It doesn't reflect the imminent bankruptcy of bullion trading banks and trading companies. And it doesn't represent the likelihood that London will run out of gold or silver. If inventories get to critically low levels in London, the London price will rise relative to New York and relative to other market prices, and gold and silver will flow back into London. That's the way international markets work. That's the way they've worked in the past, and that's the way they're working today. The flow of metal and the arbitrage and spread opportunities are actually indications of normal, well-operating markets. If they weren't, then you would see the price of gold and silver in London rising. The fact that relative to New York prices and other market prices, the fact that London prices have been rising in line with international prices and have not risen more sharply the way they had earlier in New York, is an indication that London is not running out of gold and silver, and that the bullion banks in London are not panicking or concerned about running out of silver. The same is true with the large open interest relative to inventories on the Comex. It was true in the February gold contract, which is now deliverable, and had seen a big roll forward over the course of January. And it wasn't true in April of 2011. I want to talk about what happened in 2011, April 2011. Excuse me. Sorry about that. I want to talk about what happened in April 2011 because it is important to review as an indication of what's going on right now. Silver started April 2011 around $37, $36 an ounce. It started to rise, and it rose sharply to a record level, almost $50, like $49 and some odd cents, on April 29th, right? As the price rose, silver promoters said, oh, the silver cartel is breaking down, the paper silver market's collapsing, the silver price is going to go to $100, et cetera, et cetera, et cetera. But if you looked at what was happening over the course of April, you didn't see a lot of investors buying silver. I'll show you some numbers, data in a second. You didn't see them buying silver ETFs. You didn't see them buying silver coins in any rate things. What you did see was a massive amount of open interest in the May contract, an actively traded Comex silver futures contract. March and May are both actively traded contracts. You saw an enormous amount of open interest in the May contract being bought back and rolled forward. You buy the May and you sell July. And that was where all the buying was that drove the price. Seeing that investment demand was not particularly high, in fact, some investors were selling into the rally, and seeing that it was a function of the May roll, CPM Group issued a report in April saying, this is what's going on, and we expect the silver price to rise into the end of April. And once the roll of the May contract into July is behind the market, we expect the silver price to come down. We thought it could come back down to $37. We were wrong. It went down to $35 within 6 days of May. Fewer trading days. This is what happened in the course of April. At the beginning of April, the end of March, the price was $37.89. It got as high as $48.58 on a settlement price basis. It rose 28%. By May 6th, it was back down to $35 an ounce. Over that period of time, the end of March, beginning of April, you saw 367.5 million ounces of open interest in the May contract. That was the shorts that had those positions were rolled it forward primarily. And you saw that by April 29th, the peak price for silver, open interest in the May contract had dropped to 7.6 million ounces. 360 million ounces of May contracts had been bought back. Right? By May 6th, another 4 million ounces had been bought back, and the open interest in the May contract was down to 3 million ounces. That's what was driving the price higher. Silver ETF holdings actually rose 2.1 million ounces over the course of April. That was 0.6% of the buying that you saw in the May futures contract. Silver coins, if you look at the Silver Eagle, which publishes, the U.S. Mint publishes monthly data, Silver Eagle sales were 2.81 million ounces in April. That was up from 2.79 million ounces in March of 2011. The premia actually fell because investors were less interested in buying silver, and they were selling them back to the coin dealers. So the coin dealers didn't need to buy new coins from the U.S. Mint. Important thing is the price rose from $38 to $48 and then fell within a few trading days, 5 trading days, I believe, to $35. It'll happen again. This is the Comex open interest for the May contract over the course of April into the early part of May. That's really what was driving the price up. And this is the amount of silver that was held by investors via ETFs. And you can see there was some buying, as I said, about 2.1 million ounces of silver that was purchased. And then, as the price fell, the investors in the silver ETFs sold off their silver several million ounces. So they basically bought high and sold low. I want to tell the tale of 3 clients that we had back then. One of our clients listened to our advice. He sold his silver in the last week of April at prices above $46, and he bought it back in the first week of May at $35. He had capitalized $11 per ounce in his silver portfolio. Or you could look at it the other way. He had reduced the average net acquisition price of his silver by $11. Another client bought puts at the end of April, based on our advice, and sold them back within a week at a very large profit. And then a third investor said that he had read that silver was going to $100 and he didn't sell. It's almost like a biblical tale, this parable of the talents. And sometimes life mimics what happened in the Bible. It also happened in gold in January of 2025, this month, right? At the end of December, the February Comex open interest in the gold contract was 32.9 million ounces. April, the next active contract, had 5.7 million ounces. And you heard all the silver gold promoters and snake oil salesmen telling you this was 32 million ounces, and all this metal's coming from London, and they can't meet the deliveries, and the price of gold's going to skyrocket, and the conspiracy to suppress gold prices is going to collapse, and the paper gold market will disappear, and none of that happened. By January 31st, February open interest had been rolled forward into April. 2.97 million ounces of open interest on the first delivery day of the February Comex contract. In the futures markets, at least in the precious metals markets, the first delivery day is the last trading day of the previous month. That's when the shorts go to the clearinghouse and say, you have my depository receipts. I am short February. I'm going to deliver into the February. The next day, the clearinghouse stops those issues, the issues to deliver, and they distribute them to entities that are long the February contract. So the first delivery day is the last day of the previous month. On January 31st, the first delivery day for February, we were down to 2.97 million ounces from 32.9 million ounces. April open interest, meanwhile, had risen to 40.5 million ounces. Now, that Comex roll did contribute to the 8.6% increase in gold prices, which had started the year at $2,614. And, well, actually, it started the year around $2,660. It ended the previous year on December 31st, around $2,614. It rose to an intraday record high of $2,834 on January 31st, the first delivery day, by which time open interest had gotten rolled into April. And over the course of the next trading day, Monday, February 3rd, gold prices dropped 1.3%, back to $2,800 an ounce, which it had seen in October. It was a record price in October, and it was surpassed at the end of January. And the gold market didn't collapse. You could say that the gold conspiracy also didn't collapse because it doesn't exist. And something that doesn't exist can't collapse, interestingly. Okay, so let's look at silver in February. This is the open interest. You can see on January 1st, the open interest in the active March Comex silver contract was 601 million ounces. May, the next active, was around 100 million ounces. It actually rose to January 30th, the second day from previous, the January 31st was the first delivery day. It got as high for March as 612 million ounces. You'll notice that May also had risen about 50% almost to 149 million ounces. So there was some movement into the May contract during the course of January, and there was some buying in the May contract, and the increase of 11 million ounces in the March contract was on top of that. Peaked January 30th, 612 million ounces, 603 by first delivery day of February, which is not consequential. As of yesterday, March open interest was down to 452 million ounces. So 160 million ounces of March open interest has been liquidated. Most of it rolled forward into the May contract. Some of it just simply bought back before the first delivery day. A 26% reduction in that 612 million ounces of open interest. Silver price has risen and probably going to rise more over the next couple of weeks. We had said we thought it could get to 35. Given that it's $34.06 for today, it may actually go over $35. Could it go to 50? Sure. What will it be in the second week of March? That's the question. It'll probably be back down below $35 if it gets to $35. This doesn't always push the price up, but sometimes it does. The May contract, meanwhile, has risen 119 million ounces, or 80%, and it will continue. And then during that period of time, the inventories that are registered or eligible to be registered to the Comex at Comex recognized depositories within the Comex capture zone have also risen. 33 million ounces have gone into eligible, 23 million ounces into registered, and 57 million ounces in total. So the reality is that that metal is available and the roll will happen. We expect the roll to continue over the next 2 weeks into the first delivery date of the March contract, by which time we expect most of that March open interest will have been rolled forward into May or closed out. And thus, in early March, we wouldn't be surprised to see the silver price come back down. Now, you can go back to that slide of the parable of the three silver investors. And by the way, that's a true story. All three of them are, and think about what you want to do. As I said, the silver price has risen. Most of the increase occurred in January, but we are seeing it there. You can see here the price of silver did reach $35 at the end of October, and then it came back down to $30, and then it came back down to $29, and now it's back up to $34. That's all I have for today. Little potential for short-term investors or long-term investors to protect themselves or take profits and to profit from something. You can buy a put at the end of February, but you could buy a call today. We will have our Silver Facts and Fantasies online seminar. It's a free seminar open to everyone. We've done this since 2021 in the backwash of the COVID lockdown. We will have that on February 26th at 10 a.m. You can go to our website and register to plug in and do that. You can also send us questions ahead of time, and you can ask questions during the event. And we'll be talking about our expectations for silver over the course of 2025 and addressing some of the questions and concerns that people send in. Anybody who registers will also get a free report, a small report that we do every year and have done for the last 21 years on our outlook for silver and what we see is going on in the market. Free is cheaper than the $160 that we charge for the silver yearbook. It's pretty much like a summary preview of what we think will go into the silver yearbook when we release it, by the time we release it in May. Late May. Our silver yearbook will be released on May 27th. Gold yearbook will be released March 25th. Platinum Group Metals yearbook in late July on the 29th. We've got the PDAC Silver Reception, the Silver Fact and Fantasy online seminar and report, February 27th. We're keeping busy. Take care of yourself. Take care of people around you. You can go to our website and buy some reports. There's also a lot of free reads and videos there. You can send us an email at info@cpmgroup.com about how we might be able to help you in managing your precious metals and commodities exposure. In the meantime, try to do something good for the world, and we'll talk to you next week.